today, Rajeev sir. We already had one great session with him where we spoke about his investment thought process and how the market situation was around that time. And it is always great to listen to Rajeev sir. And today, since like the global markets and Indian markets are experiencing volatility and there is uncertainty lingering around the markets, so obviously we'll be discussing around that. And first of all, let me welcome again Rajeev sir. And I would request you, in your opening note, what do you see in global and Indian market, that we would be taking questions further and also from the attendees for today. Yeah, thank you sir.
Great. Thanks a lot, Prince, for having me. I think you're doing a fantastic job of bringing people on your Twitter spaces and having them give their views. In terms of what we are seeing in the markets, I think everybody who is possibly on the call would be interested in what's going on and they would be reading. And I think I have my own views, and my views currently are that, especially in the US and the Western economies, the fact that the central banks printed a lot of money and they bought back a lot of the debt, thereby lowering the interest rate, I think is now coming home to roost, in the sense that suddenly you're realizing that many of these banks who had bought debt securities are actually significantly underwater. And, as we all know, credit is the lifeline of the economy. And if the credit and the corresponding institutions which give out credit are going to have problems, then frankly, it will create issues in the broader economy. May not be immediate, but over time. So I do think that if you look at what is going on in US with the Silicon Valley Bank and some of the other banks, Signature Bank and so on, they had actually the losses which were more than equity capital of the bank. And that suddenly makes them pretty much bankrupt, right? And yesterday I was, for example, reading Wells Fargo Bank annual report. Even somebody like Wells Fargo, they have a lot of cash on the balance sheet, so they don't have any risk of run on the bank. But they do have risk where the losses at the end of December is around $50 billion on equity capital of around $150 billion, right? So you can clearly see that some of these banks are having huge amount of unrealized losses, and some of this possibly will get offset as people realize that Fed is no more going to raise rates. But in general, I think one challenge that I'm seeing with the Western economies, especially US and Europe, is around how much are the unrealized losses that these banks are sitting with, and therefore that will slow down the economy. The positive of that is that Fed will not have to raise rates as much as they were thinking, and that is what they have indicated. So the offset possibly could come from the fact that central banks will not be as aggressive, which will allow them to not raise rates, and therefore people will not really have as much pain on the real estate market or other markets that we were concerned about. Now, similar thing is possibly playing out in Europe. I had some time back seen an article where in Germany they were saying that the German central bank is sitting at more than $200 billion of losses because of the long-term dated debt that they had bought at very high prices. So I think this phenomenon of a lot of debt security sitting on the balance sheet will possibly continue for some time. On the other hand, when I look at India, I think such problems are a lot more muted. So I think there was a report that came out in India that there the banks have obviously long-dated securities as well, debt securities, and some of the yields there have gone up. But the impact will not be as much there, just because in India, the banks, other than what they have to do for the SLR, the statutory liquidity ratio and the CRR. CRR is not a problem. SLR is where you have to invest in the government securities. Other than that, the losses are not as big. And I think I saw a report which said around 10 to 15% of the equity capital is what is possibly sitting in losses. So I think overall, I feel that Indian banks are much better capitalized than the Western banks. Like, as an example, Wells Fargo is around having a CET1 of around 10.5%, right? Where the minimum requirement is 9.2%. So suddenly you see that the gap of like 1.3% is not that big. And when you compare the same set of similar comparison to one of the bigger banks in India, you will see that they have a much higher CET capital. So I feel like Indian banks have much higher capital adequacy and CET1 capital, and they don't have as much losses as on the debt securities. So that's one aspect which I think is pretty interesting, that how all this high interest rates are impacting the bank. Now, beyond that, I mean, there are sort of many other pushes and pulls that we are seeing in the economy, both in the Western economy and and in India, and we will see how that plays out. But I think we all know that once the crisis of confidence develops, and a bank run is a huge crisis of confidence if it were to propagate too much, that is something that could have a much bigger impact, not just on the banking, but in terms of whether people are hiring, people are firing, and how that impacts the sentiment of the consumers of whether they want to invest or spend or so on. And so all of those decisions will be impacted by what we see in the broader economy. And so I think that those are things that currently will play out, and we have to keep watching. So I think this is an evolving story, but it's something that we all should be mindful of so that we can act in the appropriate manner.
So Rajiv, seeing the GDP to debt ratio in the US, do you see like devaluing the currency is the only way out, because defaulting is not in picture, and especially when it comes to US, so we cannot think of defaulting. So, what's your view around this? I mean,
Yeah, see, I don't think that to GDP high means that the default will happen. I do think a much better way of managing the debt to GDP is really by inflating the currency, right, and effectively making its purchasing power less and less, and therefore um, effectively by devaluing the currency rather than defaulting. Effectively, you're doing that, and as we all know, that the inflation in US, in Western economies, like yesterday or day before, you would have seen in England, the inflation rate is 10% plus, right? And all that the Bank of England did was raise rates by 25 basis points. So clearly, what you are seeing in the Western economies is the inflation rate being very, very high. And central banks effectively saying, listen, the inflation is high, we can't do much about it because we have other pressures and other constraints. And so I think what is very likely is that that effectively you will be reducing the purchasing power of the currency, and therefore making the debt to GDP, the high debt to GDP will get addressed by deflating or inflating away the bonds or the debt that is sitting on the economy. And I think that is what is happening the world over. And I think I would not be surprised if that will continue, even though the central banks will continue to say that no, 2% is our inflation target. You're clearly seeing that they're starting to give up on that inflation target as soon as there's any pothole that they're encountering without saying it.
so although you touched upon all the points, but how long this kind of market can persist? If I were to ask, like based on your long, rich experience and how market have behaved in the past, so what's your sense on that, Rajiv?
Yeah, I mean, these are things which are very, very difficult to have any strong views on. I think, as you know, we are macro aware. We don't really invest based on the macro, but we want to know what is happening in the economy, broad economy, and then look at specific investments, right? But I think if you look at the broader situation, as you rightly pointed out, debt to GDP is high. Inflationary forces are very strong right now. And one interesting thing, one positive thing for the US economy at least, is that the employment rate or unemployment rate is very low, employment rate is very high. And so what that means is that at least people are able to go to work, they're able to make money, and they then are able to spend. But what if you were to look at incremental changes, what you will notice is that these incremental changes are actually moving in that negative direction in the sense that people are reducing the consumption, reducing the buying of new homes, and all of that. And so what that means is that whatever was sustaining the economy in 22 when the interest rates were going up may not be as strong going into 23. And so how long this can last, I think the overall macro doesn't look that good because let's just take US economy, right? I think the US economy is having significant amount of trade deficit, right? There is a lot of debt, as you be pointed out. There is decent amount of inflation, and offsetting all that is the unemployment, which is pretty low. But we are starting to see, and we have been seeing for the last 6 months, that companies have been jobs. And at what point does it become big enough that the unemployment starts increasing? And I think that is another very interesting thing to watch out, whether really what the Fed was trying to initiate by having higher rates and therefore reducing the growth in the economy, whether that is starting to have a bigger impact. But it's very hard, and at least I don't try to call out how long it will last because there's just too many factors and things change very quickly. So rather than worrying about the longevity, I will worry about just how the trends are looking and accordingly be aware of them.
So although you touched upon that point, but again, if I were to ask about Indian banks, many investors have a confusion like at this point in time, what they should be doing. If they are already invested, what should, I mean, obviously not a recommendation, but again, what's your sense like what investors should do in such situations, especially when the balance sheets are clean and the credit cycle is just picking up. So how you see in the Indian context?
Yeah, so I do think what is happening in the Western economies versus what is happening in the Indian context is very, very different. And I think, unfortunately, people paint everything with the same brushstroke. So I do think in India, especially Indian banks, as I mentioned, the unrealized losses are around 10 to 15% of the equity capital. And I do think that the equity capital is far more than what has been mandated as a minimum capital requirement. So I don't see any problem per se in the Indian banks. The credit quality, the delinquency is pretty low. We are seeing a lot of demand in the credit, and I have been, talking to different people and listening to some of the senior folks in various financial institutions, and the sense that I'm getting is the credit growth continues to be quite strong into February and March. And so what that is telling me is that first the banks are in good position, and not just banks, even NBFCs. So the whole financial ecosystem, the lending ecosystem in India has enough capital, don't have that much of unrealized losses, and they have good growth, and they can sustain that growth because they have good capital available. And on top of all of that, the loans that they have given out are in very good shape. In fact, the delinquency rates that you are seeing are actually coming down from last quarter. Everybody's talking about how the credit quality continues to be pristine. And it can all be understood from the fact that India had gone through its own challenges from the 2018 when IFS went under, right? And since then, all these financial institutions have had liquidity problems, and with COVID, also the asset quality problem. I think all of that is now very largely addressed. So I don't think there is any issue. And also, the consumer is pretty resilient in terms of trying to build their life back, right? By wanting to take credit and by then trying to deploy that credit for their livelihood needs. So I do think that unlike the West, Indian banking system, Indian lending system is in a very good spot. And I would be surprised if we don't see that momentum continue, because remember, a lot of this lending is really being targeted at domestic economy. So while the international economy will have some impact on India, that will be much more on the export oriented sectors. But for the rest of the economy, and India is a large domestic economy, so that is what is going to enable the banking system and the credit system to continue to grow while we watch from India in terms of how the world is playing out. So I remain quite bullish in terms of how the Indian financial system is doing and will continue to do.
All right. Before I come to Sam, one more question, Rajiv sir. So basically, the Indian IT companies have a huge exposure to banks and financials across US and Europe. So how you see this will impact the IT sector as a whole?
Yeah, no, that's a very interesting question. And again, these are things that I myself am trying to make up my mind on. But in short term, I do think that there will be some slowdown. Whether it is a degrowth, I don't think so. I think, but it will be a slowdown in terms of the growth, is the sense I am having. Just because many of these financial companies, and in general, the broader economy is trying to reduce their cost by trying to ensure that they get the best value for money, right? And so, therefore, the revenue growth that many of these IT companies were seeing post COVID, which was in double digits, high double digits, those type of growth will not be available as we go forward, just because most of these IT companies are dependent on exports, and the countries which will consume these IT services are struggling, and that by definition companies there are struggling to an extent, and therefore that will have some impact. Now, the positive again for IT services is that IT services in India have done well because more and more of the IT services have been outsourced, right? So the US companies and the European companies have been trying to reduce um, domestic employment, or reduce or outsource as much as possible so that they can reduce the cost. And that is why outsourcing works so well. And I think there will be a desire on part of these companies to further reduce cost as they are under pressure. So maybe that gives a tailwind to the outsourcing industry. But overall, I think while the longer term is there and will continue to sort of play out, I think in the short to medium term, there will be some slowdown, and we will see how strong that slowdown is in terms of whether the growth is just in single digits or it becomes even lower. I think my base case would be that it sort of slows down from, if it was 15% earlier, maybe 10%. We saw recently, for example, Accenture come out with its numbers. And for those who are tracking Accenture, I think Accenture did reasonably well in terms of how its performance was. But what was funny was that actually not funny, but what was surprising was that they came out with strong numbers and then they said, oh, well, we are laying off 19,000 people. So I think everybody is starting to see the challenge of slowdown in terms of the revenue growth. And that is why they are, for example, laying off people. So I think that slowdown will come subsequently because the order book gets built over time, and then as the order book starts coming down because you go ahead and execute on the projects, then unless the new orders come in, you will start having to optimize your cost base.
Right, right. So Sam, you can go next. And for Abhishek, I don't know why I was not able to accept your request. You can try again, or if the issue persists, you may type in your question in the comments, or you can DM me. Yeah, Sam, you can unmute and ask your question. And for other attendees also, you can also ask your questions via speaker request or maybe comments.
Hey, hi Prince. Thanks for inviting Rajiv sir in your Twitter space. So I have a question to Rajiv sir. So how do you build your perception in a banking or NBFC turnaround story like Ujjivan and Piramal Enterprise?
Yeah, I think individual name, Sam, good to have you on the call. Now, in terms of your question on Ujjivan and Piramal, I think the point always, I mean, as we have always said, first of all, this is for educational purpose, no recommendation. And, I may or may not have a position in Ujjivan and Piramal at this point, Sam. Okay, so that's also something I should highlight. But in terms of any name, the only way to build a thesis around that is to do enough work. And once you've done enough work, what are the key things that you are looking for, right? And unfortunately, what happens is between quarterly results, you don't have as much of an insight into how the business is evolving, right? And so what you have to then do is you have to wait for either similar areas or companies which are in similar areas and see what they are saying and doing, right? And that is how you can extrapolate for the company that you're interested in, right? So I don't think this is an easy process or this is a static process. What does happen is you have developed a particular view on any company, and once you have developed a view, and this development of a view also doesn't happen quickly, right? I think it takes a lot of effort. You go through what the management has said, what they have done, what has their track record, how have they done in different phases of the economy, what is the opportunity you are seeing, right? What is the opportunity you're seeing from its competitors' perspective, right? So, as an example, if I were to say MFI, right, and in the MFI segment, what you will notice is even now, when you hear most of the MFI leaders, they will talk about no, the growth is pretty decent, the credit quality is very decent, right? And therefore, they feel that the growth of their loan book can continue. Now, of course, these are things which can change quickly if the economy were to have a big shock, right? And that can always happen. That is the risk. But in terms of how things are evolving, you basically look at proxies to the companies of interest and then try to assess whether that gives you enough comfort or not with whatever names you are interested in, right? On the Piramal side, again, how Piramal is changing its business model. When a company goes through changes in business models, there's a lot more uncertainty, right? From big ticket lending to retail lending and all of that. And so then you have to decide how much of additional margin of safety you need, whether that is efficient, whether the return expectations versus the risk are sort of matching out, and then decide if if you continue to be interested. And of course, on top of all that is management, what they are saying versus what they are doing, how much are they over promising and under promising. And that is again something that keeps changing as new management comes in, as mindset of the company changes given the landscape. So I would not I would encourage almost everybody to ensure that they are tracking things as they are evolving and then developing a view which is quite flexible, because nothing is constant and we need to be flexible with the point as we look at investing in any company.
Okay, thank you. Maximum time if you compare manufacturing turnaround and NBFC or banking turnaround, in banking or NBFC, maximum NPA comes after company grow their loan book. So NPA comes first and NPA comes later and loan book growth comes first. So it is very hard to judge turnaround in banking.
Thank you, Sam,
Yeah,
for your
Sam.
question.
Yeah, go ahead, Prince.
Yeah, you had some input, Rajiv sir. Yeah, you can go ahead, then I ask again.
Sure. Yeah, so that is true. What you raised, Sam, is very true. That first the loan book grows, then the NPA comes, right? Because if the NPA comes, then people will not grow their loan book. So I think that's a very fair point. But that is the challenge, right? What we are dealing with when we are investing in any company is that we are looking into the future, right? Or we are trying to figure out how the future will unfold. Of course, we could be completely wrong, and that is not how the future will unfold. And that is true, be it, when we're looking at the banks and NBFCs, it is first the loan book and then the NPAs. But if you're looking at a manufacturing company, it is first the capex and then the revenue, right? So it's not that it is any different for any companies, because every company, what they are trying to do is they are peering into the future and saying what they can do, right? And accordingly, they're taking the action, right? And their action may be wrong given how the situation turns out, or given how the competitive intensity in the businesses and so on. So I think there is no perfect answer in investing, right? And that is the challenge, and as well as the opportunity. Right? If it was that easy that you could look at it and say it's a loan book growth, so the profitability, and we can all be happy. I think then investing will become a lot simpler, and not as lucrative also. So my suggestion is that it is interesting only because things are uncertain, things are evolving, and therefore our ability to do well will depend on how well are we able to assess, and how much better are we able to assess versus others over time, not in a particular case, but over time. And that is why your understanding of the business and your assessment of the management becomes paramount.
Okay, thank you for answering all the questions.
Thanks, Rajiv. So, Rajiv, like you are aware of the tax changes in the current bill which has been passed by the parliament. So, what's your view in the sense, like, is it a very bad move, or this move have something to do of something which government has been mulling since long, so as to make the taxation simpler, or maybe you can say so as to remove long-term capital gain down the line?
So, Prince, just to clarify, the taxation, this is around the debt mutual funds where there is no long-term capital gains, and it's all sort of the marginal tax rate. Is that what you're referring to, or something else?
No. Yeah, obviously around the debt mutual funds, but again, this is just a start, so as to set a, what we say, down the line. The government is thinking so as to simplify the tax, and maybe they can also remove the long-term capital gain thing.
Yeah. So, debt mutual funds, it's not quite obvious what triggered it. And actually, when I'm trying to think, how is it in US? I actually don't invest in debt mutual funds, so I don't even know how it is. But in general, here, what I do know is that interest income is always taxed at a marginal tax rate, right? I do think that in the Indian context, the fact that the fixed deposit income was coming at a marginal tax rate, but the debt mutual funds were being taxed at indexation benefit and then marginal tax rate, was an anomaly, right? Now, whether this will extend into equities and so on is too difficult to say. But I do think one of the things that over time the government has been doing is to plugging the inconsistencies that have been there in the tax code, right? So the fact that if I were to do a 5-year fixed deposit and all the interest comes at the marginal tax rate versus in debt mutual funds, that is not the case. I actually, frankly, don't have enough of understanding to know what the world does in this case. But my view is that, how for the market-linked debentures, MLDs, where it was plugged, and those type of things, the government has been proactive in saying, listen, we don't want to create tax arbitrage situation. But and at the same time, it does seem to me that the government is trying to encourage more and more capital to come into the country. So I don't think the government will do things which will reduce the desire of investors to invest into the economy. But the government at the same time will want to ensure that the arbitrage that exists between different instruments will come down, so that people are not investing in a particular type of instrument only because of the tax arbitrage. So, for example, many people would have seen how the insurance policies were sold, and even recently, I've got messages from different WhatsApp saying, "Oh, please invest before the tax window closes." Right. So the point is, sometimes many of these products come in only because of the tax arbitrage, and I do think it is good to close those loopholes, but at the same time, not discourage capital investments into the country, because as a country we do need a lot of capital, because there's a lot of opportunities to put that capital to work.
Right. So Rajiv, like if we talk about smart money movement, so how you see going from here would be, I mean, obviously we cannot guess it to exact, but again, any sense how FIIs ought to do in such situations when the global economies. So will they pull money from the equity markets and prefer fixed income things, or this is just a temporary situation and it will improve down the line?
Uh, and just to clarify, Prince, you are talking about FPIs into India and whether equities versus debt, right? Is that what you said?
Right.
Okay. No, so I think FPIs have been concerned, and I think FPIs have been concerned because of how the macroeconomy looks, right? And we talked a little bit about it. And whenever they are concerned, the goal always is to pull the money out from other markets and consolidate it into their home market, for the simple reason that there is a little bit more safety, or you feel safer if it is in your markets. And then the second thing has been that the opportunity cost of keeping cash was very, very low, or very, very high, sorry, of keeping cash, because effectively cash was giving nothing, while putting it into other instruments can be meaningful, right? So therefore, people were not keeping cash. Now, given how the environment looks, there is a desire of having a little bit more cash. And that cash is also earning something while you're waiting out and seeing what the situation looks. So that's one aspect of it. I think the second aspect is that in general, 22 was a good year for Indian equities as compared to the rest of the world, right? And so if the Indian equities did better, then Indian equities on the relative basis became a little bit more pricier as compared to the rest of the countries' equity market. And so when 23 came around, I think people said, well, if I am seeing more headwinds, and by the way, I think the Indian market may not be as cheap or as compelling, I think let's be a little bit more conservative. But, and I think this is a huge consideration people need to have, which is which economy will grow well, right? It is very easy to look and say, okay, 23, how it will be. But I think if you ask me, I think Indian economy will continue to be the fastest growing economy across various countries. And I think Indian economy is in a very sweet spot, both in credit cycle, the demand cycle that we have talked about. And therefore, I think the opportunity for Indian companies to continue to do well is immense. The second thing is, inflation comes. One of the safest places to be in to offset inflation is actually to invest in businesses, right? Because businesses can give you returns that are much better than inflation over time. And therefore, you will be able to actually do much better than in the fixed income securities. And so my view is that if you are looking very short term focused, then yes, maybe doing these tactical moves where you withdraw money or put money here or there could be useful. But if you are thinking a little bit medium term, then I do think Indian economy and Indian equity market is really a wonderful opportunity. And this is now then taking us to the topic that we had, which is navigating uncertainty and seizing opportunities in volatile markets. And my view is that when things become volatile, that is when you get opportunities. If things are if it is a continuously going up market, then you don't see that many opportunities. And so when you see opportunities and you are able to take advantage of that, that is how you are able to actually do well in investing. And this is precisely where, there is just too much of institutional imperative, as Buffett talks about, where people want to do what others are doing. And in the short term, that looks correct, because what everybody is doing is what is causing the market to move the way they are, right? But if you really look at what creates or what generates the best returns, it is not necessarily following what others are doing, even though that may be painful. And so for people like us, we are happy to take advantage of the opportunities that volatile markets may give us, and actually, invest in areas that we think are more compelling, just because the prices have come down and maybe the business still looks as compelling. So overall, I don't think, I do think that people have their own sort of push and pull, but from our perspective, we think the opportunity set in Indian equities have only become better just because the prices have come down. And obviously, nothing is uniformly true. So in some cases, prices have come down. In some cases, they've remained the same. But if you like a business at price 100 and it comes down to 80 and the business profit changed materially, then obviously it's a better opportunity in terms of returns.
And true that, very well said. And even the investor participation is decreasing. That itself shows when the pessimism increases, so the value emerges. So that is very true on your part. So Rajiv, like as we spoke last time, we discussed about various sectors where you see value. So is there any addition to those sectors? Maybe other pockets of opportunities you see coming, maybe in the sense of sectors, not specific to any companies?
Actually, my view on the sector since our last time, so which was maybe 3-4 months back, is pretty similar. Hasn't really changed too much because I haven't seen too much of, or I have the data that I've seen, and maybe I'm biased here, but the data that I have seen sort of is just giving me the same similar view. And one of the things, Prince, always is that what I understand better is where I want to focus on. So I think the sector views are similar. I do think domestically sectors are likely better, as we were discussing, than export-oriented sectors in the short term, even, right? And so, be it financials, be it real estate, some of the chemical companies maybe possibly could also be interesting. Building material, infrastructure, those are another interesting areas. But, investing is all about not just what will do well, but how are they priced, right? And that second element is what people always have to remember. And this is where I do feel many people forget that it's not what sector will do well, but it is also what is the price that you're getting when you are looking at these companies. And that, I think, is really important. And my suggestion to anybody who is looking at companies or sectors or whatever is, yes, prospects are good, but are the good prospects already priced in? And once you look at it from that viewpoint, then I think you can figure out better opportunities in the market.
Right. So Sam has another interesting question. So he's asking how to sit quiet when we have cash in hand but do not have opportunities to invest.
So you have cash, but you don't have opportunities. That's what he's saying.
Yeah, so he's asking like how to manage behavior in those times, because whenever we have money, we have an urge so as to invest in one thing or the other.
Yeah, no, that's a very good question. And I will say, since many of the folks here might be Buffett fans, I definitely am. Buffett says, listen, the mistakes I made is most of the time the mistakes I made is when I have cash and I don't, and I basically want to deploy it, right? If I have cash, there is a tendency to deploy it. How do you sit quiet? Not easy at all, first thing. Second thing, how do you decide where to deploy? Should always be based on what is your best opportunity, right? So if today I feel a company can give me 20% returns by deploying in that, and then you say, well, that company, I already have decent allocation, I don't want to deploy more, then you should ideally be deploying the next money, whatever that is. Let's say the next opportunity you are saying can give you 10% return. Then it's a big gap between 20 and 10. And so the question is, should I be deploying at 10% or should I be waiting? And that really depends on how big is your opportunity set, what all are you seeing, and how comfortable are you if your portfolio were to go down. Because ultimately, in volatile times, while there is a lot of value in keeping cash, but unless you deploy cash, you are not taking advantage of the volatility. And so the way I approach it is that I always like to keep some amount of cash. And as I'm deploying cash, what I am also trying to do is to free up some cash from the opportunities that may not be as interesting compared to what I'm seeing in my portfolio, right? So basically, you look at your portfolio and say, what are the compelling opportunities and what are the least compelling opportunities in my portfolio, right? And effectively, what you can do is you take your incremental cash and deploy in the most interesting opportunities. But you can also pull out cash from the least interesting opportunities in your portfolio. And that way, you will keep some cash. I will give you a very interesting answer that I received from Harvard Marks. So I was attending a conference, and Harvard Marks was talking about how they deployed massive amount of cash in the 2008 crisis, right? And I said, listen, that's all good that you deployed, but at some point you will run out of cash because you are a portfolio manager, you are managing other people's funds. So how do you take care of it? He said, every fund manager is different. What I had was a situation where I can call money from my investors, right? They always they raise funds. And in those raising funds, they say, listen, whenever we need money, we will ask you to send us money to its investors, right? So in case of Howard Marks, he did not have that problem that he will run out of cash because he can call money from his investors. For people who are managing their own portfolio, though, right, we cannot call money from other people. So how do you then raise cash? And that actually is the crux of it. And I do think having the willingness to then rotate money from the least interesting to the most interesting, at least I find, is interesting. Another is I always feel people should keep some amount of cash. When the markets are going up, everybody wants to be fully deployed and really have no cash available. I think that has a huge downside because then you cannot really take advantage of opportunities when they show up. And so keeping some cash, but then also having the ability to raise cash by deploying or by taking money out of your least interesting positions is one way I do it.
Rajiv, another dilemma which every investor they face at least in their initial phase of investment is like, should they do upward averaging or downward averaging? Because if the price goes up for a security, it is very difficult so as to deploy more money. Whereas it is like if the business is doing good, you should be deploying more cash, right? So how one can condition this situation so as to be take things so as to their advantage in such cases?
Yeah, no, I think it's a fundamental question all of us face. And averaging up or averaging down, I think is how we shortcut or how we talk about it. But really, what we are doing whenever we are deploying our capital is trying to put it into the best opportunities we are seeing, right? So as you rightly pointed out, if a stock is going up, but the business prospects are going up faster, then averaging up is not a problem at all, right? On the other hand, if the business prospect is going down and going down faster than the price, then of course averaging down makes no sense. So I do think that whether it's averaging up or averaging down, it should only be done in the context of how the business is doing. And unfortunately, we don't have as much signals about how the business is doing as compared to the price. Price is changing every day. Business is possibly changing every day, but we only get some meaningful information about the business, let's call it once a quarter, right? And so the frequency of price moves and the frequency that the price is indicating that something is going on versus the business details are not mismatch, right? And so because there is that mismatch, what I would encourage people to do is to really have your own understanding of the business and the management. And I always highlight that management, while it is as amorphous a concept, it is the most fundamental thing because at least I find for myself that if I have confidence in the management and even if the stock price were to go down and indicate something is negative, I feel comfortable. Feel comfortable with the management. I'm happy to average down because I feel the management will do the right thing, right? But if I have doubt on the management, then it's very hard to do that. And so I do think in especially times when things are uncertain, being in good businesses with good management makes all the difference because it is then that you're able to continue to be in that position and also actually take advantage of and possibly increase your position if the price were to give you more compelling opportunities. On the other hand, if you don't have the comfort, and I have been in situations where I did not have the comfort um, with the management and the price went down, my actually comfort went down with the price, even though nothing has changed on the business. And so that is what at least for me, I have observed that if I see things which are going down, then suddenly I start having a lot more doubts. If I originally had a doubt in terms of how the management will do. Because I always say in the Indian context, unless you have comfort with the management, it's very, very hard to make any money. And so that's at least what I find for myself.
Right, Rajiv. I totally agree on the management thing, and that is the first and foremost important thing when it comes to investing. So another, like, without naming the company, if there is a good business and we see tailwinds in the business in coming days, and there is a management tussle going on, and that went into litigation. So in such situations, I mean, how the investor should be behaving? Because in one side they are thinking the business is good and tailwinds will happen in days to come, and on the other hand, the uncertainty is on the part of the management is in loggerheads and had gone to the court for deciding some matter. So what's your take on in such situations? How one should go about tackling such situations, Rajiv?
Yeah. So first is, in such situations where some new development happens that you were not expecting. In this case, of course, you're seeing management at loggerhead onto the court. Now, to the extent that this is a new situation, I think the question that an investor should look at is how much of a margin of safety or what sort of a return expectations you have built into the position at a given price, right? And then say, is that giving me enough margin of safety knowing the uncertainty, right? And then you should also play out whatever that new information is, right? For as an example, rather than the management tussle, and I know one company which recently came in the news, pretty well known, at least one investor group pretty well known and another not, at least I do not know. But yes, they went to the court. I frankly don't track that particular company, and I don't know if that is a company you are referring to here, but I don't track it, so I don't have a view on it. But when let's take the question a little bit more broader and say, listen, a new information has come out, right? You are invested in the company. What should you do? I think the way I would approach it is to say, how much does the new information impact the company? Sometimes we don't even know, right? Now, it could be management, sometimes management personnel has resigned from the company, right? Possibly, right? Or now you say this was that person to the running of the company. How, in your mind, how compelling is the opportunity of being invested in the company vis-a-vis something else, right? And sometimes, like in COVID, we don't even know. You don't even know what any business will do because that was a unique situation we had never encountered before. So in many cases where you don't know, I at least tend to be more of the mind that let's not do something just because a new information has come out and we don't understand it, right? Unless we think it is a real big negative, right? And once you feel it is a real big negative, that's a slightly different viewpoint. But if you feel the new information is not going to have a big impact, but you don't know, right? You don't know. But your general sense is, yes, maybe a little bit positive, a little bit negative, whatever that is, but not a big change, then most of the time the market will overreact. And I think it's better for you as an investor not to overreact. So most of the time, I would then tend to not react as much. But if I have a strong view, oh, this is really bad. COVID was really bad. But then the price also fell quite a bit. And now the price has fallen and things are uncertain. What do you do? At that point, you basically look at your own opportunity set and see if something looks much more certain than others, right? And you have cash available, then you can possibly take advantage of it. But in general, trading too much, buying and selling too much is what I find too many people do. And it is ultimately going to hurt their returns rather than help them. So I would, and I tend to not actually act as much just because something has happened which I don't understand. I would rather stay put and keep looking at new information to the extent I can find, which will help me either confirm my decision which is to stay put or to act. But the general tendency is not to act as much as the news flow will indicate.
Yeah, totally makes sense. And the point which you made is very relevant, that you should have some margin of safety in case of uncertainty. Great, thanks. So, Mr. Majnu, you can unmute and ask your question. So, Rajiv, another interesting question is from Sam again. So, he's asking, like, what is your process to sell a stock when managing own money versus public money?
Yeah, so my process is very similar. Yeah, I don't because whether I'm managing public money or my own money, so as people will know, I run a fund. I am the biggest investor in the fund, so it's my own money even there. And so the idea is that, and I always tell people who come into my fund that the way I will manage that particular fund is how I manage my money. And the idea is to take advantage of the opportunities that I am seeing, and where I feel much more convinced about a particular idea, I tend to take a bigger position, right? And so many people say, oh, because I'm running a public money, I want to be very diversified. We don't really do that. We do think that when you find an opportunity that you understand and feel it is a good opportunity, then you want to take advantage of it, right? I don't know how many of the listeners recently read Buffett's 2022 annual letter that came out in February. Things he says is that in his 60 years of running Berkshire, the the there are only 15 positions approximately, or 14, or maybe even maybe 12 positions, 12 to 15 positions, that has really made a difference in how Berkshire has done. And so effectively one every 5 years, right? And if he had not taken advantage of those opportunities in a meaningful manner, Berkshire will not have the track record that it has. And so I do think, in general, in the market, I find that people are too docile and people don't really take advantage of the opportunities when they come. And I do think that is, in my mind at least, not the right way to do it. First, you need to keep working, right? And then occasionally, very occasionally, you will find ideas that are really, really compelling, right? And when you find those ideas, then you need to have the willingness to put some amount, meaningful amount, so that you can take advantage of them. And that is how I invest in my personal portfolio, and that is how I invest when I am investing in the fund, because the people who come into the fund, they are quite understanding of the approach that we have, and that is what they want us to do. So one of the things which we try to do again is to be very long term oriented, both in the personal portfolio but in the fund. And really the whole intention there is that it helps us ignore the short term noise, the current noise, for example, in the markets that we are seeing. And my view is, by ignoring that short term noise, we can actually think much more beyond the next quarter or the next year even, and therefore worry about many of the things that we might have talked about in the call today, right? So the intention is to think about the business rather than worry about too much about the macro, right? And that is what we try to do, and then really take advantage of the price when it goes down. And that is exactly what we do in the fund. And so there is no difference in how I invest in the fund versus how I invest in the personal portfolio.
Great. Many thanks. And for our attendees, like Rajiv sir has been kind to agree to my request of coming again in time of volatility. So we owe him so that we can reciprocate and follow him, so as to ask him to be more active on Twitter, and obviously we can gain from his years, maybe decades of experience in obviously as and when the situation demands. So Rajiv sir, we are almost done with all the questions, and I think we did justice to your time. But again, before we close, any closing remarks and any advice to our investors who are experiencing such kind of volatility for the first time?
Yeah, I mean, I think I always recommend to investors that they should do their own work if they're investing for themselves, right? Or if that is what they want to do. They should look at and listen to everybody, their ideas, their recommendations, whatever. Should not make the assumption that just because somebody is saying a particular idea is good, it is good. Different people have different understanding of the businesses and understanding of the management. And unless you feel that you have a good understanding of both the business and the management, and you understand at what price something is good, I don't think we should invest, because I think, at least I see, that many people start feeling that just because setting up an account and opening an account is very easy, that investing is easy, right? And that is not. It is simple, but it is not easy, as Buffett will say. And what I think people make a lot of mistake with is they just want to just follow somebody who has done well. You will never know when somebody invested in a company who is really doing well and when they got out of it, and nobody wants to tell you that, right? They might say, oh, this is a good stock, but why is it a good stock, and what should you do when things go down, what should you do when things go up, is not something anybody will tell you, and that is something that you yourself have to come to terms with, and that you can only come to terms with if you understand it. So I would encourage everybody who is keen to invest to think first that you're investing in the business, think long term, come up with your own conviction. Use ideas from others, that's not a problem, but develop your own conviction. Learn yourself the art of investing, the pitfalls of investing. And then, when there are opportunities, especially in markets like what we are dealing with now, volatile markets, and you have the conviction, then you can take advantage of it. Again, Buffett in 73, 74, when the markets had fallen 60%, right? US markets was very, very exciting. And the reason was he could actually look at and say, no, the opportunities are really, really compelling, right? And I'm not saying the opportunities currently are that compelling or anything. I'm just saying that when the opportunities become compelling is when people run away from it. And by doing that, they actually take an opportunity or an advantage that they have and turn it into a disadvantage. And so, but only by understanding the business and the management and themselves will they be able to take advantage of the wonderful opportunities that we get in the equity market. And I wish everybody good luck, and I hope that people keep learning from each other and teaching each other. And it's great to be part of this forum, Prince. So thanks for inviting me.
Thanks again. And Rajiv sir, like good thing about investing is we are never short of questions. So another quick question comes to mind, and I would request you to take that. So basically, we all make mistakes when we start our investment journeys, right? But what any mistakes which you see like we make in later parts of our investing career, later in the sense like if we have 2-3 decades of experience, if I take your example maybe, so in such cases, what kind of mistakes are those? Any different, or I mean, any mistake which comes to your mind?
Yeah, so actually, I did a recent conversation or interview with one of the other teams, and they were saying, "Listen, please tell us what has been your biggest mistake." So I will repeat that here to emphasize the point I was making earlier. And so the biggest mistake I made was a company where I had 100% losses. Okay, so whatever I invested, it went to zero. And the name of the company is Temptation Foods. I don't know how many people here will know that. But that particular company, and this is, I invested in like 2012, 13, somewhere in that time frame. And even today, if you ask me why did I invest, I don't know. I did not understand the business. I can't tell you why I invested in the business. Why? So the question then becomes, why did I invest in the business? I invested because I read its annual report, and it was a sort of a glossy magazine. I mean, I think most people will not know it, but Temptation Foods, really, it was just arranging foods and have beautiful models, and it was just a magazine, right? And I said, oh, okay, this looks good. But it was clearly a bias I was having, right? And so, relating it to the point I was making, because I did not understood business then, I did not know what to do when the price fell. And then psychological denial came in, and I stopped following the stock. So the stock price was falling. I'm like, no, it will come back, right? And I would not even look at how the business is evolving. And so because of that, I said, "Nee, it will come back and then I will sell it and get even and get out," right? And unfortunately, it never came back to my buy price. So there was loss aversion, there was psychological denial, and so on. And so I think going back to my point, if you don't understand the business, you don't understand the management, you have no business of investing in that company. And that was the cardinal mistake. So I think early on, many investors make this mistake of saying, oh, something looks interesting, let's buy it, even if we don't understand it. And I think that mistake is a lot more prominent in the early part of one's career because you are swayed by other people. So somebody expert is coming in, they are saying X, Y, Z, and you think, oh, because that person is good, successful, therefore X, Y, Z should be good, and let me go and buy, right? So that is where you are influenced by the expertise of other people is a lot more common early on in the career, right? And then I think over time, what does happen is that you become more aware of that. But then the mistakes that you are likely to make, which Buffett always talks about, is the mistakes of omission. You understood it, but you were either trying to be too cute with the price, or you just basically did not pay enough attention to the opportunities and you let them go. So later on in life, I think it is because opportunities are rare. When you find an opportunity, you want to take advantage of it. And the mistakes of omission later on become a lot more because you keep uh, because you might not have that many opportunities. I think that the early part of your career is mistakes of commission, later part of the career is mistakes of omission.
Great, great. Many thanks, sir. So, guys, please follow his handle, and you will surely get so much of insights. And obviously, time and again, when things happen around my global events, and he share his view on his handle, so that that would also be helpful for everyone. So, thank you again, Rajiv sir, and surely look forward to have you again as and when we feel like the situation demands, or maybe we need your assistance in those times.
Yeah, sure, absolutely. I enjoyed it. I think I always enjoy these sessions because these are not scripted, and so you always have to, figure out what the questions are, and many times questions are the answers, right? Because it helps improve one's thinking. So really enjoyed the session and all the wonderful questions. Thanks a lot, Prince.
Thanks again, sir.